In this lesson, understanding Fibonacci trading, the learning objectives are: you should know what Fibonacci numbers are, you should know what Fibonacci retracement levels are, and you should know what Fibonacci extension levels are. If you studied in school, really, you would have heard the name of Leonardo Fibonacci, and you may be familiar with Fibonacci numbers. Leonardo Fibonacci created the Fibonacci sequence, and this is a set of numbers that begins with a 0 succeeded by 1, and then the pattern continues based on the rule which states that all subsequent Fibonacci numbers will be equal to the sum of two previous numbers. 0 plus 1 equals 1, 1 plus 1 equals 2, 1 plus 2 equals 3, etc. The Fibonacci sequence is 0, 1, 1, 2, 3, 5, 8, 13, etc. You don't need to know this, but it's good to understand the history behind it and how it works. These numbers are significant because Fibonacci numbers are strongly respected on the charts, as a vast majority of traders use them. Fibonacci sequence levels are used for calculating Fibonacci retracements and Fibonacci extensions, which are levels frequently used. You should know that as the Fibonacci sequence proceeds, any number is 1.618 times the preceding number and 0.618 of the subsequent number. The 0.618 and 1.618 numbers are called the golden numbers, or the golden ratio. There are several Fibonacci trading techniques. However, all Fibonacci trading techniques anticipate price action, attempt to find support and resistance areas, and are calculated based on a selected market swing. Fibonacci can be used to define precise entry and exit spots and offer a useful framework for analyzing price action. For example, 38.2% retracement is a shallow pullback, and a 61.8% is a deep pullback. Instead of blindly classifying pullbacks, we have a framework to help us assess pullbacks by using Fibonacci retracements. In order to apply Fibonacci levels to your charts, you will need to identify swing high and swing low points, but we'll get onto that. You need to decide what a market swing and high is, and adjust the selected swing as price action unfolds. A rule of thumb is to focus on major and clear market swings. Do not clutter your chart with too many lines and curves. A swing high is a candlestick with at least two lower highs on both the left and right of itself. A swing low is a candlestick with at least two higher lows on both the left and the right of itself. Here are the Fibonacci retracement levels. They are 0.236, 0.382, 0.5, 0.618, and 0.764. They are based off the golden numbers and the whole Fibonacci sequence. But you don't really need to know it, and it's just unnecessary to say. Always add the Fibonacci retracement, which is 0.5 level, when using the Fibonacci techniques, as it is often a key support and resistance level. It is not a Fibonacci sequence number, but you should still add it anyway, for the above reason. Fibonacci retracement levels work on the theory that after a big price move in one direction, the price will retrace or return partway back to the previous price level before resuming in the original direction. Traders often use the Fibonacci retracement levels as potential support and resistance areas. Here are Fibonacci extension levels: 0, 0.382, 0.618, 1, 1.382, and 1.618. Traders use the Fibonacci extension levels as profit-taking levels.